This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
Our guest is Sunny Shakawala. Thanks for being on the show, Sunny.
Hey, Whitney. Thank you for having me.
Now, I'm honored to have you on the show. And Sunny is a serial entrepreneur currently focused on managing a 45-unit commercial asset as well as building out a private money lending business. He has grown his lending business from $100,000 loans originated in 2016 to over $2 million originated in 2018. He invests the bulk of his profits from both businesses into multifamily syndication with a select few trusted partners. Each deal sponsor specializes in a different market and asset class, which provides diversification in location, tenant base, and deal life cycle. I'm looking forward to getting into some of that and how you do this, Sunny. But tell the listeners a little more about you, and then let's dive into your expertise.
Sure. So serial entrepreneur, I graduated college and the first thing I did was open a food cart. That was pretty fun. It was serving chicken and rice, like Mediterranean style, on my college campus. I did that for a year before selling that off. From there, I joined the corporate world, did consulting for a little bit for 2 years before saving enough money to open up my next restaurant, which was a massive failure. That was 3 years that I wish I could get back. But the third year of my restaurant operations, I did my first real estate deal, which was a private money lending deal. And I had made more in that deal than I had made in the previous 2 years combined in my restaurant. So I was like, you know what? Got to get rid of this restaurant as fast as possible and dive right into real estate. So I've been doing that now for a couple of years. And I think the complement to my real estate, my private money lending business is just finding good syndicators and backing them and supporting them and trying to get more returns that way. So that's where I am today.
Nice. So you're finding deal sponsors that you qualify and that you want to work with. And I want to say, we're going to go through that process a little bit and how you have chosen different people that you want to work with. I know a lot of the listeners are in those shoes or trying to get started, whether they are a passive investor looking for that first, deal or syndication that they're looking to invest in, or even if they're a deal sponsor or somebody pursuing to be a deal sponsor. This is going to be great information for them from somebody from your experience and your side. So, let's start with, maybe some things that are important to you when you're looking to get started investing in a syndication, or maybe when you started, and then let's get into, how you interview the sponsor, and then we'll go to the deal and some different things. But initially, let's help that passive investor who's looking for their first syndication.
I think the absolute most important thing that a deal sponsor can show you is a track record, right? So I don't want to say never invest in someone's first deal, because there's always exceptions to the rule, but you're really looking for someone who's been in the business for a while, right? Let's say at least 6 years at this point. Because there's new syndicators popping up every single day. There's just very little barrier to entry. So time in the game. So 6 years at least. They have at least $100 million under management. They have at least 1 million square feet under management, or 1,000 units, right? So it's one or the other. It's just to show that they can manage a large portfolio. Another thing that I like to look for is that they've taken at least 5 deals through the deal life cycle. What is the deal life cycle? That's acquisition, that's value add, and that's either a capital event like a refinance or a supplemental loan, or a disposition. I prefer disposition, right? Because they're selling off the asset and then it's complete. But if there's a refinance or a supplemental put in, the investors are getting their money back, and from there or at least some of their money back, and from there it's usually much higher returns and much less risk. So that's the number one thing that I'm looking for when I'm interviewing deal sponsors, is that track record.
Nice. So I know there are aspiring syndicators that are listening, thinking, oh, it's going to take me forever to get there, or, how do I get started, or, you mentioned that, don't necessarily never invest in someone's first deal, or, maybe there's other things to look at. So, could you speak to that for just a minute? How would somebody, because if this was always the case, then, how does someone get started, or, get somebody like yourself to want to invest in their first deal?
This is that common problem. Even when people are looking for jobs, right? It's like, oh, we're looking for someone with more experience. And it's like, how do I get experience if no one's willing to take a chance on me? That's a really good question. So I have actually invested in someone's first syndication. They were a student of someone that I usually invest in. So I knew that they had the education required. And at the same time, their deal structure was more favorable towards the investors. So a lot of times you'll see like a 70-30 split. This syndicator's, or this first-time syndicator, his deal structure was 80-20 to the investors, which was obviously favorable. So a lot of the times you'll see like a 6 to 8% preferred return. This first-time syndicator provided a little bit more than that. So I guess when it's your first deal, you have to give up a little bit more, right? I'm now investing in people that are doing 35-65, right? Because they have that track record, because they know they're good, and because they know investors are still going to come to them, right? So as you grow your business and as you have more time in the game, you can start recapturing that value. But if it's your first time, I think you're just going to have to, I mean, there's probably multiple ways to do it, but I think giving more value to the investor is one way.
Nice. No, that's great advice. Great advice. I think most of us have been in those shoes, and where we've tried to give a lot more to the investor to get started, at least initially, and gain that track record, and just show more of alignment of interest as well, to some extent, but give a lot more back. So, you mentioned at least 1 million under management, 6 years in the business, 1,000 units, 1 million square feet. I think you had mentioned, and then. I guess, I'd like to go through how you interview a sponsor, what that looks like, maybe any other questions you like to ask, the actual sponsor themselves. Let's dig into, those things a little bit.
So it's multiple touch points, right? It's not one phone call where I take up an hour or two of their time, because honestly, I'm looking for 2 to 3 hours of their time across probably a month time span, because I just have so many questions. And I think people are afraid to take up too much time of someone like a syndicator, right? So like a busy person like a syndicator, but at the same time, we are parting with our hard-earned money to invest in this person. So it takes time to build that relationship. So I would go into this interview process, sort of like expecting maybe 3 to 4 half-hour calls over the span of 30 to 45 days, where I can kind of drill them on different things. And the first conversation would look like track record. The second conversation would look like, what's your team, right? I definitely do not want to be backing a one-man show. I want someone who has asset managers. I want someone who has like full-time underwriters, or not full-time as in he's paying them like a W-2, but full-time as in these people are underwriting 100 deals a month, and they are just passing forward what they like, right? And that's those 100 deals are boiling down to one deal that they're forwarding to that syndicator. Someone that has an assistant at the very least, right? Because time is the most important thing, and having an assistant is you need that. A syndicator needs that type of person. Analysts, right? People that are doing market research, an acquisitions manager. Like these are just like the basic types of positions an established syndicator would have. So that second conversation would look like who's on your team. The third conversation I'd have would look like, what does your communication look like with your investors, right? Is it a monthly email? What are you sending on a quarterly basis? Are we going to see financials? Are you holding events? Like, do you come out to, do you make like a national tour, right? So one of my syndicators, he's based in Ohio, but he comes to New York once a year. He goes to California once a year, and he's going to Texas once a year, and those are where most of his investors are. And he's inviting everybody out, so we can get FaceTime with him and with our peers. So, because what people may not understand is, or what you might not understand before you invest your money is, it's kind of like a marriage. Right. You're going to be in this type of situation with this person for the next 5 to 7 years. So you want to be sure that you are getting the communication that you require. And if they're not providing it, then just move on to the next person. I actually invested in this syndicator probably a year or two ago now. And I gave him my investment, and about 6 months passed, and I didn't even see an email. And I was like, this is just not for me. I don't like this. So I emailed him and I was like, hey, I'm not a fan of your communication style. I'm sure you're going to do great, but can I just get my investment back? And he was like, you know what? Sure, no problem. And he wired me my money back the next day.
Wow.
That was probably probably like surprising. I mean, that was a fund. So it wasn't like my money went towards one specific asset. It was a little surprising that he did that and he didn't try to like keep me or anything. But at the same time, I just wasn't comfortable with his communication style and I couldn't force him to communicate with me only because that doesn't scale, right? And then the fourth conversation I'd probably have with any syndicator would be more deal specific. I'd ask for examples of past deals, right? What did the returns look like? If they're willing to share with me, what does a sample K1 look like the annual return for a specific investor, right? Obviously, blank out the name and the social security numbers and all that stuff and provide that to me. And I'd ask for more proof that they were doing what they said they were doing. Because it's very easy nowadays to go online and download a picture of some multifamily asset and put it in a nice spreadsheet and put it on your website and talk about it on your podcast and look like you're the man. It's very easy to do that. What's not easy to do is fake a closing sheet, right? Fake a warranty deed. Ask for those types of documents.
Our guest is Ramana Shares. Thanks for being on the show, Ramana.
Thank you, Whitney. Thank you for the great show. I'm glad to be part of the show.
Yeah, we're grateful to have you on, especially with your experience. I know you'll be able to add tons of value to myself and the listeners. And so we appreciate your time. I'm grateful for that, Ramana. But a little about Ramana is a co-founder and managing partner of Raven Multifamily, which acquires B and C class multifamily assets in landlord-friendly and growth markets. His company has syndicated 2,700 units in 3 different markets in the last 3.5 years. He's passionate about adding value to investors as well as tenants. So, Ramana, thank you again for being on the show. Tell the listeners a little more about, maybe your background and how you got into this syndication business.
Absolutely. Thank you for the opportunity again here. So, folks, my name is Ramana Shares. I live in Frisco, Texas, which is part of Metro DFW. I'm an immigrant to this country. I came here in 2001 for my master's. As everybody else, I finished my master's, started looking for a job. I found a job. I was roaming across the country with my job, but I always have this passion to do something else other than my job. So I was exploring different opportunities in multiple areas, not knowing anything, not formally educated in any other than my day job. I never stopped my thirst to exploring, right? So I started partnering with a few of my friends, started investing in retail strip centers. So I found 2 of them, I partnered, and I wanted to replicate in the hometown of me, which is Dallas. So I was able to get many people interested in the business model. But by the time, guys, it's ready to send your funds, but nobody was doing that. So that gave me a pause, and thinking in the retrospectively, what I realized is these folks do not have any formal education. I mean, they are believing in me, but they are not able to make a decision if that's a good investment for them or not. So that pushed me into finding a right mentor where my job is not to educate people, but rather I wanted to make the investment successful. So I found, until then, my focus was on retail strip centers. But after I found this mentor in Dallas, I felt like multifamily is the way to go. Okay, because end of the day, everybody has to live under a roof. And the class of the property that my focus area is B and C, where that C being the lowest in the class, of course, that's where the value add comes into picture. But by targeting that C-class properties, I was able to pull most of the sophisticated and accredited investors into these deals. So this is where I learned the multifamily knowledge base, and I networked with so many folks with a similar mindset. I started investing passively and quickly learned how to syndicate. And I found my partner, Venkat Avasarala, in the same mentoring group. We started working together, and we started with a 100-unit property in Oklahoma City. moved on to 120 unit in Glendale, Arizona. That gave us enough credibility in the market, and we picked up a 300 unit property in DFW market. Since then, we've been purchasing in DFW. So we finished our 11 syndications with 2,700 units. We sold
11th syndication?
That is correct.
Awesome.
Thank you. So we exited from 3 deals out of these 11. So we are actively managing the 8 properties. We don't self-manage. We are working with third-party professionally managed companies in DFW market, and looking forward to get to our 10,000 unit mark in the next few years. Part of this process, I worked in IT for 15 years. And after having few properties, it's kind of overwhelming with the investor relations, with property management, with all the 9 yards with the property management, right? So with that, myself and my partner, we quit our 15-year career IT jobs, and we are doing this full time.
Nice. Well, I appreciate you elaborating on that. I know lots of people that are listening are looking to do the same thing, and you all have accomplished a lot. 11 syndications. That's a great. It's a great experience, and I know you all have learned a lot. So, tell me, why don't we talk about a recent acquisition, and let's kind of dive into that deal a little bit.
Absolutely. So my apologies for not able to make up my scheduled time with you, because this property taught us a whole lot than anybody would think. So in the first 10 deals, myself or my partner, we never struggled to raise money. Even in the last 3 deals, we were able to raise like $9 million in 24 to 48 hours. Not everybody deposited their money into LLC's account, but we were able to get full commitment within no time. But something changed in the market. So, if I think back, what I could realize is definitely the recession talk is more than it was, a few months back. And multifamily is still the hottest market. So price per pound is definitely killing. And there are a lot more syndicators in the market right now than a couple of years ago. So a lot of availability of these opportunities. Of course, investors have to make their complete due diligence before committing to their funds. They have to underwrite, they have to vet the syndicator, they have to vet the submarket, they have to vet the market, they have to look at the underwriting, how well these syndicators are doing. All these factors into, before investing in anybody's deal. Even though our underwriting is very conservative, very investor friendly, still we were not able to pick up the $8.2 million raise, not easily. So it took good 3 weeks this time. Definitely, price per pound is one of the key factors that we have to keep in mind. So before purchasing or getting into contract, that will be my criteria for sure. On this particular deal, this is a 280 unit Arlington property. It is 1970s built. Seller, whom I know, we know before. They manage around 5,000 units across Texas and the Colorado markets. Very sophisticated seller. They spent around $4 million in that 280 unit property. They took care of pretty much entire exterior renovations, and also they upgraded 48% of the interiors as well. And they showed us the good path to increase the rents. So it was no-brainer to win this deal. Basically, this was an off-market property that one of the prominent broker got to us from Dallas market, and same shop provided good 80% LTV loan on the property. That helped us real big time. Finding a right lending partner is key to success in this business as well. See, end of the day, the more proceeds that we get from the loan will help lesser equity raise, which will produce much higher, much better result to investors.
And I want to say, congratulations though to you all to be able to raise, $9 million in just a couple of weeks. Normal, before even, but I know you said this time you struggled, but you still got it done in 3 weeks. That's still, most people listening would still be jumping up and down to be able to raise that kind of capital, even in 6 weeks. And so you all are obviously doing something right. I know you elaborated a little bit on just how the market's changed and maybe why, it was a little more difficult to raise the capital because these investors have so many more opportunities to look at now. But what was it that really helped close that gap for you all? After a couple of weeks, you all noticed that, okay, it's a little more difficult now to raise the capital than we expected. What was it that, pushed you to reach your capital raise goal at that time?
So basically, we didn't reach out all the people in the first place. So obviously, we reached out and we made a few phone calls with the past investors. So they came forward and invested with us. And also to keep the underwriting very attractive, conservative for the investors, right? We didn't include a lot of other income opportunities in the underwriting in the first place. Some of the investors were asking, hey, how come you didn't add any, it could be washer dryer income, it could be tax savings that the city of Arlington is reducing. We can implement covered parking, reserved parking. We can get cable internet contract to the property. I didn't include all these in the initial underwriting. So when I added all that stuff, it definitely showed much higher, much better result for the investors or investor returns for the investor. So that helped pull that gap very quickly. Wanted to keep it as much conservative as possible. Still, I don't want to, false promise, right? End of the day, once investors likes your business model, the things that we do, we have a very clear communication with our investors. We don't false promise. If something is not being right in the property, that's what we communicate. We don't oversell to any investors. Hey, if you're interested, please invest. If not, let's move on. We'll share our next opportunity with you. You can join. No selling, clear communication, clear expectations. In our webinars, we make sure that we communicate, okay, this is how the communication is going to be, and we try to be in the same schedule. So, and also we had pretty good success with the sales of or the exiting of 3 properties, right? So that helped us secure our 2,700 portfolio in 3.5 years.
Wow. No, you also said numerous things there that we should probably elaborate on a little bit, but for the sake of time, I'd like to know a little more about this deal. And you had elaborated 280 units in Arlington, 1970s build, and who the seller was a little bit. They had already upgraded 48% of the units, and that it was an off-market deal that a broker brought to you. Tell me, right now, I know everyone is struggling with finding the deal, right? Quote, the deal, the next deal. We're seeing lots of properties, but they seem to be so overpriced. What was it about you all or the relationship or the connection or, that allowed you access to this off-market deal?
End of the day, brokers has to represent sellers. You can have as much as a relation you can have with the brokers, but you have to give a warm and fuzzy feeling that you are the closer, one way or other. We go into these contracts with the mindset of 60 days to close. Okay, luckily or fortunately, or the way how we perform, for me and my partner, we always, as most of the deals we closed at least a few days before the 60-day mark. So we have that reputation in the market that we are the closers, and we are, we can close early too. And on this particular deal, we closed this deal, how many days? A week before. Okay. Even though we struggled to raise money, we were able to close a week before. So why I'm saying that is, obviously, you have to impress the broker with your due diligence before setting up the tour. Okay. You make sure you read the OM, you understand the market, you understand the submarket, you understand the property. You, if needed, go and visit the property multiple times. Feel comfortable, so that if you are prepared, well prepared before the setting up the tour, broker will get impressed upon you, and he will see the urge in you that you want to win the deal. Now you have to give the comfort that you can raise the money if you are a syndicator, or if you have your own funds, that's well and good, right? So as soon as the broker feels comfortable that you are a closer and you have a resume that shows that you are a closer, then definitely brokers will come after you. Of course, like I said, brokers have to represent the seller. There are a lot of syndicators and institutional partners are looking to park their money in this multifamily asset class. So you have to compete with lot many folks than you would think.
Thank you for being with us again today. I hope you have liked and subscribed to the show. Please tell your friends about the Real Estate Syndication Show, and I hope that you are learning and growing. Don't forget to go to lifebridgecapital.com where you can start investing today.